Thank you for tuning into the Equity Channel, where we provide the highest quality stock market analysis to individual investors. Our goal is to help you improve your returns by keeping you up to date with everything you need to know. What helps investors beat the market is information and knowledge of how to use it. We'll provide you with both. Before we get started, be sure that you subscribe and turn on your notifications, because every time we drop a new episode, money is made. Today, we're doing our monthly review of the economic outlooks from Wells Fargo and the Conference Board, two leading sources of economic research. We're focused on their projections for growth and monetary policy. Along with that, we're going to discuss the key areas of risk for the economy and what opportunities that brings us in the market. As usual, we're not doing any long introductions. Let's get straight to it. The Conference Board forecasts that U.S. economic growth will buckle under mounting headwinds early next year, leading to a very short and shallow recession. This outlook is associated with numerous factors, including elevated inflation, high interest rates, disappointing pandemic savings, rising consumer debt, and the resumption of mandatory student loan repayments. They forecast that real GDP will grow by 2.4% in 2023 and then fall to 0.8% in 2024. Stating the obvious, we either believe the economy will grow more than expected, as expected, or less than expected. Our three most recent recessions were made worse by a collapse in real estate prices, a collapse in stock prices, or a spike in oil prices. All three of these scenarios are currently on the table, but they can be prevented. We can avoid a spike in oil prices if the world's top producers decide to raise production and global conflicts don't impact supply in any major way. Remember, the economy is already slowing. Any spike in oil prices will hurt corporate and consumer income across the country. To avoid a collapse in asset prices is a bit trickier. With unemployment projected to rise in 2024, any number that comes in above expectations will signal a worse than expected economic slowdown. What we'll need to avoid higher unemployment and a collapse in asset prices in 2024 is an increase in money supply. That's controlled by the Federal Reserve. When central banks cut interest rates, it puts more money into the economy, making it cheaper and easier for people and businesses to borrow and spend. This stimulates the economy, increases the demand for goods and services, and for assets. According to Wells Fargo, the Fed is projected to start lowering interest rates by the second quarter of 2024. Of course, those projections are under the assumption that there are no major spikes in oil prices and inflation has been tamed. What does this mean for the stock market? This means that borrowing costs should normalize over the medium term, lowering credit risk for lenders and stimulating growth by making it cheaper to raise capital. This means that any drop in stock prices that's not accompanied by higher oil prices, higher than expected unemployment, or the notion that the Fed will leave rates higher for longer is a buying opportunity. With an economic slowdown still underway and the potential for a worse than expected recession still on the table, investors should focus on consumer staples, healthcare, and utility stocks first, building up the more stable, dividend-paying, lower beta side of their portfolio. This will keep things stable in the event that the market does decide to take a downturn. Now next, I would ease into some industrials, basic materials, energy, and real estate. Once these things are taken care of, the coast should be clear to load up on some banks, technology, consumer cyclical, and communications. Look for times where these sectors are underperforming the market to make your move. That should give you a margin of safety. I would also focus on buying at times where the S&P 500 is at or below its 50-day moving average. This should help you better time your purchases. The Equity Channel is one of the most followed stock market podcasts for beginners, a valuable resource for investors who are looking for information on the stock market and the economy. We love to make our episodes quick, straight to the point, and rich in value. We hope that's what you got today. Be sure that you subscribe, turn on your notifications, because every time we drop a new episode, money is made.